Assalamualaikum warahmatullahi wabarakatuhu. Innal hamdanillah wassalatu wassalamu ala rasulillah. Amma ba'd. Bismillahirrahmanirrahim. This is Muhammad Kamrul Hussain, Department of Business Administration, Metropolitan University, Sylhet. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Today we will try to start leverage. Leverage, we will try to discuss the topic named leverage. So here you have said that here is a word lever and age. That is a financial term, leverage. So I would like to send you several pictures. So here you are seeing that. So she used a stick to upload a huge amount of things with a small sticks. Here also this man used to afford this box by a single piece of stick. Here you are seeing a huge amount of mud in here, and this is the machines which will help you to carry this very easy. Here also you see this is a stick which you will provide a small strength, and you will afford this pin. And here is also you see the nail culture. If you hold in here, you press a small amount of energy, then you cut your nail by a big force. So actually these are the related to finance things. So we use this concept in leverage. So if you use in your capital structure a small amount of or a amount of debt to your capital structure, then it will enhance your profitability. So actually that is the leverage. So now you will see leverage refers to furnish the ability to use fixed cost assets or funds to increase the return to its shareholders. That means fixed cost asset, that means debt. If you use debt or fund, increase its return to its stockholders. So as like your firm's return every year as like 2%. So if you use this leverage, it will enhance to 3%, 4%, or 5%, or any other. That means obviously it should be enhanced by using leverage. That means if you use debt to your capital structure. So again we will see leverage is an investment strategy of using broad money, especially the use of various financial instruments or broad capital to increase the potential return of an investment. Leverage can also refer to the amount of debt a firm uses to finance assets. The leverage can also refer to the amount of debt. That means leverage are totally related to the debt. Leverage refers to use of debt or borrowed funds to amplify returns from an investment or project. Investors use leverage to multiply their buying power in the market. So that is another thing. The multiply buying power. Such as you have 1 crore taka. If you take loan from the bank, another 1 crore taka, you have 2 crore taka for your purchasing power increasing double. So you can earn profit by double. So here is also risks. Leverage is also risks. So you have to pay the fixed cost to the bank or any other financial institutions. So companies uses leverage to finance their assets instead of using a stock to raise capital. Companies can use debt to invest in the business operation in an attempt to increase shareholders' value. So in this way, leverage can use to enhance the shareholders' value. So simply we will understand leverage. Leverage is a use of debt. Leverage is use of debt to magnify firm's return. Firm's return. So leverage is use fixed cost or debt to magnify firm's return. Firm's return, that is the leverage. And types of leverage. Leverage basically two types. Like leverage basically two types: operating leverage and financial leverage. Leverage basically two types: operating leverage and financial leverage. And these two leverage can create another leverage, that is total leverage or combined leverage, or you can call combined leverage. So basically leverage two types: financial leverage and operating leverage. And these two leverage create another leverage, that is combined leverage or total leverage. Now, operating leverage. Actually, leverage arises by the fixed cost. So you know there is the two types of fixed cost: operating fixed cost and financial fixed cost. Whenever firm use the operating fixed cost, then arise operating leverage. In the same way, whenever the firm use financial fixed cost, then there arise financial leverage. So it is very clear to us that operating leverage, the leverage associated with the investment activities is called operating leverage. It is caused due to fixed operating expenses in the company. It arises fixed operating or the fixed operating expenses. So operating leverage may be defined as the company's ability to use fixed operating costs to magnify the effects of change in sales, its earning before interest and taxes. Operating leverage consists of two important costs, that is fixed cost and variable cost. When the company is said to have a high degree of operating leverage if it employs a great amount of fixed cost and a smaller amount of variable cost. Thus, the degree of operating leverage depends upon the amount of various cost structure. Operating leverage can be determined with the help of the break-even analysis. So there has a formula for calculating operating leverage, that is OL. Operating leverage is equal to C divided by OP, where OL equal to operating leverage, C contribution, OP operating leverage. So later on we will discuss about this matter. After that we will see degree of operating leverage. Percentage change in profit by the percentage change in sales. That is create the operating degree of operating leverage. So degree of operating leverage may be defined as the percentage change in the profits resulting from a percentage change in sales. It can be calculated with the help of following formula: DOL, degree of operating leverage equal to percentage change in profit divided by percentage change in sales, or you can call it percentage change in EBIT, earning before interest and tax, divided by percentage change in sales, that is DOL. After that we will see here we will see DOL, percentage change in profit, or you can call EBIT divided by percentage change in sales. Financial leverage arise by the use of financial fixed cost, for whenever a firm take loan from the bank or financial institutions, that firm has the financial leverage, or you can call it the lever firm. So leverage activities with the financing activities is called financial leverage. Financial leverage represents the relationship between the company's earnings before interest and taxes over operating profit and the earning available to the equity shareholders. Financial leverage is defined as the ability of a firm to use fixed financial charges to magnify the effects of changes in EBIT on the earning per share. It involves the use of funds obtained at a fixed cost in the hope of increase in return of shareholders. The use of long-term fixed interest bearing debt and preference share capital along with share capital is called financial leverage, or trading one equity. Financial leverage may be favorable or unfavorable, depends upon the use of fixed cost. Favorable financial leverage occurs when the company earns more on assets purchased with the funds than the funds cost of their use. Hence, it is also called the positive financial leverage. Unfavorable financial leverage occurs when the company does not earn as much as the funds cost. Hence, it is also called the negative financial leverage. Financial leverage can be calculated with the help from the following formula: financial leverage, FL, financial leverage equal to operating profit, EBIT divided by profit before tax, PBT, profit before tax. FL, financial leverage, equal to EBIT divided by PBT, profit before tax. Okay. Degree of financial leverage. Degree of financial leverage may be defined as the percentage change in taxable profit as a result of percentage change in earning before interest and taxes. This can be calculated as a formula DFL equal to percentage change in taxable income divided by percentage change in EBIT. DFL equal to percentage change in taxable income divided by percentage change in EBIT. So it has another formula. Financial leverage is equal to EBIT divided by EPS. Financial leverage is the ability of a firm to use fixed financial financial changes to magnify the effects of its EBIT and EPS. Financial leverage. So financial leverage is equal to EBIT divided by EPS, earning per share. After that, we will see combined leverage or total leverage. When the company uses both financial leverage and operating leverage to magnifications of any change in sales into a larger relative change in earning per share. Combined leverage is also called the composite leverage or total leverage. Combined leverage expresses the relationship between the revenue in the account of sales and taxable income. Combined leverage, you can calculate combined leverage equal to operating leverage into financial leverage. So, and operating leverage, you can calculate operating leverage in this way as C divided by OP into operating leverage divided by profit before tax. Operating profit before tax equal to C by T. Okay. We can see in here combined leverage CL equal to OL. OL means operating leverage. So we know the formula for operating leverage. What is the formula? C, contribution divided by operating profit into FL, financial leverage. We know the formula for financial leverage: operating profit divided by profit before tax. Profit before tax. So if we cut this two topic, operating profit, we can found C, contribution divided by profit before tax. So combined leverage equal to contribution divided by profit before tax. So in here we shows this matters. C, contribution, OP, operating profit, PBT, profit before tax. So the percentage change in firm's earning per share result from 1% change in sales. This also called the equal to the firm's degree of operating leverage times its degree of financial leverage as a particular level of sales. So you see in here that degree of combined leverage or degree of total leverage equal to percentage change in EPS divided by percentage change in sales. you can find the combined leverage. So here it is clear that if you change 1% change in cells, then what happened to your conditions of EPS? That can be determined by the degree of combined leverage. So it is clear that 1% change or 2% change, what will happen to your operating profit? So at first operating leverage. So if you change your sales, what 1% change, what happen to the conditions of your operating profit? Operating profit. What happens to your operating profit? Then, if you change sales, what happened to operating profit? And what happened to your profit before tax? Profit before tax. Then what happened to your S? So it is related to one another matter. So in this way, you can calculate the percentage change in sales. It affects to the percentage change in EPS. So it is related to one another, sales to EPS. That is the combined leverage. Sales to operating profit, operating leverage. Then operating profit to profit before tax. Operating profit, profit before tax. Then financial levers. Then if you multiply operating profit and operating leverage and financial leverage, you can get the combined leverage. In the next class, we will try to solve several problems. This all about today. Stay home, stay safe, try to maintain a safe social distance, try to wash your hands frequently in a day. Subhanaka Allahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaika. Assalamualaikum warahmatullahi wabarakatuhu.